What's going on, everybody? What's going on? I hope everybody is doing well. I appreciate y'all for tapping in as always for another episode. Please bear with me as I get everything together. What's going on, everybody? We're back. We're back again. We're back again. We're back again. Please bear with me here for 1 second. I want everybody to understand today's a perfect opportunity to build wealth. Today is a perfect opportunity to build wealth. Today is the perfect opportunity to build wealth. What's going on, Instagram? Hope y'all are doing well today. Please come over to YouTube so y'all can see me share my screen and everything. Sorry it's taking so long to get everything set up, but I'm trying to make sure everything is good. So we've already wasted too much time, but let's go ahead and get into everything again. For everybody who doesn't know who I am, my name is Devon Elder. I'm a 28-year-old civil engineer, and I created the Trade for Yourself podcast, where the mission here is very simple. I just want to help everybody learn how to trade and invest in the stock market for themselves. So please like, please subscribe. Make sure you hit that notification bell so y'all can be in the know every single time I drop an episode, okay? So the title of today's episode, when will stocks go back higher? Now, I have a lot of commentary on this. I have some thoughts, but right now, we're going through some turmoil in the market. We're in a bear market. And, this is just something that we need to get used to. We need to get used to being in bear markets because we were in bull markets for so long. When I came into the market, I was in what we had a bull market. We were in a bull market. Stocks were going up no matter what happened. But now we're in a bear market. Okay, so now we got to ask ourselves the question, when will stocks go back higher? Now, understand this. Stocks went through the worst quarter, not just the worst quarter, the worst first half. Stocks went through the worst first half that it's had since 1970. And the number one reason, the primary reason why stocks were down as much as they were in the first half was because of inflation, right? Investors pay for growth, okay? They pay for growth over the long term. But when the cost of goods and services are higher, people are not going to spend money. When people don't spend money, the earnings for companies come down. When the earnings for companies go down, their stocks will go down because investors pay for growth in the future. They don't pay for growth right now. So I want to go through some things that we need to look at to see, okay, since we know that inflation is the number one reason why stocks have been down in the first half, what we need to know is that means that inflation itself has to come down before stocks can go back higher. So when will stocks go back higher? When inflation comes down. And there may be some economic data out there that we can look at that we can say, you know what? We may look here and we may say, you know what? I think stocks could be coming. We can see stocks going back up and we can see inflation coming down. So let me go ahead and share my screen real quick. Look, if you're on Instagram, tap in with me over here on YouTube. I'm sharing my screens. I'm going through some things here and I want to see y'all. I want y'all to see what I really truly got going on. So if we share our screens really quick here, we want to go through the Fed minutes. Okay, so the Federal Reserve released their meeting minutes. Okay, now keep this in mind. I want to put this into perspective. These minutes came out. These were minutes that were released today, but this meeting occurred in June. So it's kind of like backward looking, but forward looking at the same time. So the Fed sees more restrictive policy as likely if inflation fails to come down. So the Federal Reserve officials at their June meeting said another interest rate increase of 50 or 75 basis points is likely at the July meeting, according to the minutes released Wednesday. Policymakers recognize the possibility that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist. Now let me break that into simple terms. Simply put, investors want the Federal Reserve to take control of inflation, okay? Because investors see that the Federal Reserve has been lacking. They have been lacking and they have missed the boat the last 2 years on inflation. So what investors want the Fed to do is to take responsibility for making sure that inflation comes down. Now, the one thing I want to tell you is that commodities, okay, energy, food, commodities, right? Energy and food are the main reason why inflation is high right now. And when I show you this article right here, oil tumbles as much as 10%, breaks below $100 per barrel as recession fears mount. Now, let me tell you this. The fact that oil is coming down is a good thing, okay? Other commodities like copper, like wheat, like corn, like cotton, these prices are coming down, okay? We need these prices to come down and we need the prices to stay down in order for stocks to move higher. That's what you really, truly got to pay attention to. We need these commodities to come down in order for stock prices to go higher. So oil prices plummeled Tuesday with the U.S. benchmark falling below $100 per barrel as recession fears grow, sparking fears that an economic slowdown will cut the demand for petroleum products. But at the end of the day, that's what the Fed is trying to do. The Fed is trying to have demand to slow down so inflation can come down, and they're going to raise interest rates to try to balance everything out. So the oil market appears to be homing in on some recent weakening in apparent demand for gasoline and diesel. Okay, so that is probably due to what? Is due to the curtail of the oil demand and what the Federal Reserve has had going on. Now, let me go back to the Fed minutes. Let's go back to the Fed minutes and see what they were talking about. In discussing potential policy actions at upcoming meetings, participants continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate to achieve the committee's objectives. In particular, participants judge that an increase of 50 or 75 basis points would likely be appropriate at the next meeting. Now, understand this. Raising benchmark borrowing rates by 3/4 of a percentage point in June was necessary to control cost of living increases running at their highest level since 1981. So the one thing I want to tell you is that Federal Reserve Chairman Jerome Powell, he is taking inflation seriously. He is taking inflation seriously, and other members of the Federal Open Market Committee are taking it seriously. Okay, so they needed to raise these interest rates in order to be able to take these things seriously. Okay, because like I said, when will stocks go back higher? Let's go back to the title of the episode today. Okay, when will stocks go back higher? They'll go back higher, number one, when inflation comes back down and stays down. And number two, they'll go back up when the Federal Reserve becomes more accommodative. What do I mean by more accommodative? What I mean by more accommodative is that when the Federal Reserve stops raising interest rates so much and we just kind of flatline and they maybe even cut rates at certain times, that's what's going to make the market go back higher. Okay, so understand this. They said that they will continue to do so until inflation gets closer to their 2% long run goal. So the Federal Reserve is going to continue to increase interest rates until inflation comes back down. Once inflation comes back down, they'll stop raising interest rates. Participants concurred that the economic outlook warranted moving to a restrictive stance of policy, right? And they recognized the possibility that even more restrictive stance could be appropriate if elevated inflation pressures were likely to persist. They acknowledged the policy tightening would come with a price. Participants recognized that policy firming could slow the pace of economic growth for a time, but they saw the return of inflation to 2% as critical to achieving maximum employment on a sustained basis. Now, I agree with that as well. The move to hike rates by 75 basis points followed an unusual sequence in which policymakers appeared to have a last-minute change of heart after saying for weeks that a 50 basis point move was almost certain. Following data showing consumer prices running at an 8.6% 12-month rate and inflation expectations rising, the rate-setting Federal Open Market Committee chose the more stringent path. Okay, so they're saying that they want to raise interest rates. They're saying that that's what they want to do. Now, if the commodity prices keep coming down, like commodity prices have been crashing as of late, if they continue to come down, that will kind of allow the Fed to be more accommodative, not more restrictive, but more accommodative. Officials at the June 14th to 15th meeting remarked that they needed to make the move to assure markets and the public that they are serious about fighting inflation. Many participants judged that a significant risk now facing the committee was that elevated inflation could become entrenched if the public began to question the resolve of the committee to adjust the stance of the policy as warranted. Okay, the document added that the moves combined with communication regarding the stance of policy would be essential in restoring price stability. However, the approach comes with the U.S. economy on shaky ground. Now, we're about to come up on GDP, gross domestic product, right? That's the goods and services going in and out of the economy, pretty much what is added onto the economy. Okay, gross domestic product in the first quarter fell 1.6% and is on pace to decline 2.1% in the second quarter, according to an Atlanta Fed data tracker. That would put the economy in a technical, though historically shallow recession. Okay, since the last meeting, economic conditions have weakened as financial conditions have tightened. What markets want to hear now is what the Fed has in mind if economic data releases continue to signal a deeper move or deeper, more serious downturn without a commensurate easing in inflation. Okay, so the Fed officials at the meeting expressed optimism about the longer term path of the economy, though they did lower GDP forecast sharply to 1.7% in 2022 from a previous estimate of 2.8% in March. So that's why the Federal Reserve is saying that we are in inflation. Okay, that's why they say that we are in inflation, and that is why most people feel that we are in a recession because of these GDP forecasts that are coming in. Now, they noted some reports of consumer sales slowing and businesses holding back on investment due to rising cost. The war in Ukraine, ongoing supply chain bottlenecks, and COVID lockdowns in China also were cited as concerns. Okay, officials penciled in a much bigger inflation surge than before, now anticipating headlining personal consumption expenditures prices to jump 5.2% this year, compared with the 4.3% previous estimate. PCE 12-month inflation was 6.3% in May. Now, understand this. We said that inflation needs to come down, right? But this is one thing I want you to understand. These commodity prices have been coming down. Okay, these commodity prices have been coming down. So this is a great thing to understand, and this is a great thing to look at. Like I said, when will stocks go back higher? Stocks will go back higher when inflation comes down and the Fed is more accommodative. So the minutes noted that risks to the outlook were skewed lower for GDP and higher for inflation as tighter policy could slow growth. The committee prioritized fighting inflation. Officials noted that the policy moves, which put the Fed's benchmark funds rate in a range of 1.5% to 1.75%, already have yielded results, tightening financial conditions and lowering some market-based inflation measures. The two measures which compare inflation index government bonds with treasuries have moved to their lowest levels since autumn of 2021. So the minutes noted that after a series of rate hikes, the Fed would be well positioned to evaluate the success of the moves before deciding whether to keep going. They said more restrictive policy could be implemented if inflation fails to come down. So officials indicated a series of increases that would take the funds rate to 3.4% this year, above the longer run neutral rate of 2.5%. And futures markets are pricing in a possibility that the Fed will have to start cutting rates as soon as the summer of 2023. So this is a lot to really truly digest. Okay, so like I said, we'll go back again. I don't want to keep beating the dead horse, but the title of the episode is When Will Stocks Go Back Higher? First thing is we have to understand is that we had the worst first half for stocks since 1970. The number one reason why that happened was because of inflation. Okay. The Federal Reserve has a dual mandate. It is the United States Central Bank. The dual mandate is to have maximum employment and to have price stability. They have had maximum employment because employment is still below 4%, which is still historically low. So they are meeting the first mandate. The second mandate, price stability, they are missing the boat on because CPI inflation was 8.6%. The measure for inflation that the Fed has, PCE inflation, they're marking that estimate up to 5.2%, which they had at 4.3% prior. Now understand this, like I was saying, how is inflation going to come down? A big contributor to inflation has been commodities. Commodities have been a huge cause to inflation. So think oil, think copper, think lumber, think cotton, think natural gas, right? All of these prices for these commodities have tanked. They have failed to 17-month lows for copper. You got 17-month lows for copper. Oil is down more than 23% from its high right now. Cotton is down low. Like all these commodities are low. If these commodities continue to go lower and they stay lower, even though we go into a recession, it doesn't mean that the stock market is actually going to suffer from it, because the stock market right now is working on pricing things in. When news comes out, the stock market works on pricing it in. They work on pricing it in to find a fair value for stocks and the entire market in general. So in order for us to go back higher, we need inflation to come back down. If inflation comes back down, the Federal Reserve may pause raising interest rates, right? They may pause raising interest rates, which will give the market and give investors more incentive to say, you know what, let's put some more money back in the stocks, because eventually the market will get tired of the bad news and eventually we will be able to get out of this period. But we're going to have a long-term mindset and a long-term horizon in order for this to go well. Now I'm going to stop sharing my screens real quick. Now this is really all I have for today. All I really have for today was just going through understanding when will stocks go back higher and what's going on with the Fed, right? So we understand that the Fed is going to be releasing their minute meetings. Okay. The Fed is going to decide what they're going to do in terms of interest rates later on this month. We're going to be hearing about GDP, right? And then we're going to be hearing more about the term recession, okay, later on this month. But what I want you to understand is that you got to have a long-term mindset. Eventually, all of this inflation stuff will come to pass. All this stuff will come to pass. Eventually, the war will come to pass. Commodities, ongoing supply chain shortages and all that stuff is going to come to pass. COVID lockdowns, all it's going to come to pass. The main thing I need you to understand is that you got to make building wealth a priority for your life. That's the first thing. You got to make building wealth a priority for your life. And once you make building wealth that priority for your life, then what you got to do is invest in certain asset classes. So I love talking about the stock market, right? So you got to invest in the stock market, invest in the stock market, pick your stocks and hold them for the long term. I'm telling you, over a 3 to 5 to 7 to 10 year time span, we will look back on 2022 and we will remember how bad the stock market was. But eventually we are going to get through this and make it to the other side. So as always, I appreciate y'all for tapping into the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every time I drop an episode, okay? So remember, don't pay for it, trade for it. I'm gonna tap in with y'all on the next one.